Hey guys, how's it going? Back with another video covering capitulation and forced selling. So basically what I want to talk about in this video is how one of the ways that I basically buy, like get into the market, get into my positions. Now this this analysis of charts and technicals is mostly for coins in the top 300. This wouldn't really work as well on meme coins. I mean, you could use the concept on meme coins, but the data that I'm going to be showing you in this video, which is what, we're looking to analyze the technicals and the technical tools that I use for measuring capitulation, for measuring forced selling, doesn't work on meme coins. It's not going to show you. Now, let's say on Bitcoin, it crashes, the market capitulates, the meme coin capitulates, probably finds a bottom at the same time as Bitcoin does. So you can sort of indirectly use this data on anything. However, the data itself only can be put onto Bitcoin, Ethereum, Solana, blah, 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 the main coins. So let's, go over this briefly. So one of the buying strategies is buying capitulation. I have a bunch of data to measure when the market is, having capitulation happen. And capitulation happens 1 to 3 times a year, usually like 1 time or twice. And it basically represents like a really, really good buying opportunity, like one of the best buying opportunities you'll get. Because crypto is such a volatile space, it's such a new technology that sometimes things just break and people panic. And they panic way more than they should. And this leads to short-term inefficiencies where price trades way lower than what it should be trading. Because when something breaks, it gets fixed, but people sell coins really low as if the problem's never going to go away. And they panic, and it's this panic that gets us these opportunities to buy, which are really good. So I want to go over capitulation in terms of how it works, some examples of when the market went through capitulation, and then go over some of the tools that I use to measure capitulation. So yeah, capitulation and the tools I use is one of the methods of technical and chart analysis that I do, essentially. So let's talk about what is capitulation. So visually, let me show you. Oh, you can't see me anymore. I'm now a ghost. So visually, let's get rid of some of this shit. It is basically when the market basically just dies, right? Like it's a big crash that happens where people feel the need to capitulate on their positions, meaning they give up. They just need to get out. They need to sell. They need to leave, right? So this would be like a capitulation. This would also be a capitulation, this sort of massive crash where people are losing heaps of money, they're panicking. Maybe people are forced to sell as well, right? The concept of a forced seller also relates back to the concept of capitulation. They sort of happen hand in hand. And so what I'm trying to do with this method of technical analysis is spot when the market is having a capitulation event so that I know when to buy, essentially. Now, capitulation, like I said, can be from intense fear, or it can be from, a big liquidation event. So, for example, let's imagine there's like $1 billion of people trying to long the market, and then there's someone who dumps the market, and these longs get liquidated. When you close a long, you have to sell, right? That's $1 billion of selling. That puts the price lower. Because the price went lower, more people get liquidated who sell, who make the price go lower, and more people get liquidated. And it creates this spiraling effect of, it's called a cascading liquidation, right? So let's draw this up. So you got price, it's chilling, people are buying here, crash, right? Let's say they set their stop loss here. Or let's say they get liquidated here, right? They get liquidated. They have to sell, so then the price goes lower. More people had their liquidation levels here, so then they sell. So more people had their liquidation levels here, and you can see that it's just this continual downward movement of liquidation, 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 until eventually buyers come in and they create a bottom. And at this point here, like this rough region is where we want to buy. It's after that forced selling, that liquidation, that capitulation has occurred, and we use tools to measure this, okay? So why is capitulation the bottom? Well, capitulation is basically the price at which there is the most opportunity for buyers, because when you think about it, selling and buying is driven by emotions, what is the strongest emotion that someone can feel that leads to them wanting to sell at the lowest price? Well, it's capitulation. Capitulation is the strongest emotion an individual can feel that will make them want to sell something at the lowest possible price. Because something you guys need to understand is that price and sentiment are like completely intertwined. So let's say price goes like this, makes lower lows, right? The sentiment tracks this, right? You never have a period where people are getting really bullish, right? Let's say that this is sentiment, right? S. And the price is going like this, right? It sort of maybe a little bit can happen, but it doesn't really happen, right? It's like the price and the sentiment are generally very intertwined. You're never going to get a crash sideways and then another crash and the market is more bullish here than when it was there. No, the market gets more scared the lower it goes. And, you know, let's say capitulation happens, right? Capitulation is the largest, that's not the largest, it's the strongest emotion that a human can feel in relation to investing. There's nothing worse that can happen. There's nothing more scary that can happen that would make them want to sell lower than that event of a capitulation. It's just the lowest, it's the worst, it's the scariest. It's the point where people are willing to pay to sell things for the lowest possible price that they would ever consider selling. So that's why capitulation is so powerful, because it represents the point at which the most opportunity for buyers, because it is the point where sellers are willing to sell at the lowest possible price that they would ever consider selling. Okay? So, because when you think about it, right, price is a battle between buyers and sellers. Smart people, right, smart people buy fear. Smart people like us buy capitulation. Inexperienced people, they sell during capitulation. I've done that a lot of times. The COVID crash, I actually sold a little bit of my portfolio into the COVID crash. I sold the capitulation. If I was smart, I would have been really loading up at that crash to 3K during COVID, during whatever it was, 4 or 5K. So yeah, the actions of experienced people, they control the price, right? When the price crashes into a capitulation, it's the smart people who obviously, the experienced ones who have all the wealth, who end up buying in, right? They put up, they put up the walls of the bids, right? These walls of bids. This is all the experienced people, and I'm going to show you a wall of bids in one of the tools that I have to measure this. Okay? So let's talk about forced selling as well. So Loomdart tweeted this tweet pretty much at the bottom, right? Let's have a look at the chart. When was the bottom? It was like, you know, December, 20th of December, you know, late November. That was the bottom, okay? My birthday, November the 22nd, was actually the lowest price the market ever went. Isn't that funny? Didn't realize that. So basically, forced selling is what he was talking about here, because remember what was happening back during the last crash. FTX collapsed. That led to systematic risk in basically the entire crypto market, because people had lended money to FTX. That money was now gone, meaning these companies basically lost their money. Also, a lot of projects had money stored on FTX, right? They might have had their treasuries kept on FTX. Well, that's gone now because they can't get their money out. A lot of people and projects had their money in the FTX token. That went to basically zero. So you can see that there was a lot of people who had lost a lot of money, and you know, like a lot of, let's say a lot of these protocols like Celsius, for example, they, you know, these big companies that basically had to shut down their entire company, declare bankruptcy, they have to sell their portfolios, their coins, to be able to refund people. Now, I don't remember any specific examples of who were the big sellers back then, but just imagine a number of different firms who declare bankruptcy, they have to liquidate their portfolios, who are basically forced sellers of billions of dollars of Bitcoin, Ethereum, whatever coins that they had. What price is a forced seller willing to sell their coins at? Well, they don't get to choose what price they sell at. They will sell at whatever price the market gives them. And thus, the bottom of the market is often represented through forced selling, because there is no one who is willing to sell a coin lower than someone who is forced to exit their position, because someone forced to exit their position must take whatever price is given to them at the time of selling. And they don't have time to wait to sell. They have to sell regardless of what the price they are getting is. In fact, they are probably grateful that they get a price to sell at, given the amount of coins that they generally have to sell. Think about how many billions of dollars of coins had to be sold during that whole FTX saga at the bottom, when a lot of people wouldn't have been buying because of just absolute fear, right? And that's why we got such low prices on coins like Solana, a lot of forced selling. People thought it died with FTX. A lot of people thought it was over. Not many people willing to buy. So, that concept of forced selling is really interesting. Whenever you guys are noticing in a market where people are forced to sell something, that's where you need to be paying attention to be a buyer, because you have to recognize that the price is probably not going to go any lower than where people were forced to sell it, because no one will sell a coin lower than a forced seller. Okay? Now, one other concept I want to talk about is liquidation. So when traders get liquidated, traders represent people who have a short-term time preference. So their impact on the market is very short-term. When you have $1 billion of short liquidations, it's $1 billion of the trading pool of capital that is being sold. The trading pool of capital is just being traded daily between different groups of people. It's not actually increasing or decreasing the amount of coins on an exchange, right? Because when you think about it, there's two types of buckets of wealth. There's the exchange money, right? The coins that are on the exchange. And then there's the sort of rest of the coins, right? Which are stored in, they're like a hodl, right? There's like the hodl coins. These ones are not on an exchange. They're in people's wallets. And when a long-term investor buys or sells, they are either increasing or decreasing the size of the trading pool. When a person who is a derivatives trader buys or sells, the pool stays the same, because it is the same. It's traders selling to other traders, right? This pool stays the same. Now, when a liquidation happens, what is happening is this pool of capital is selling billions of dollars of coins sometimes, and it's being scooped up by wealthy spot buyers, right? Liquidations are a forced transfer of wealth from traders in this pool to wealthy spot buyers. So it's basically a massive shrinking event of this pool of people, right? Let's change the color. Of this pool being sent over this way. So the trading stack shrinks and the hodl stack increases during a liquidation event, right? Because these people close their positions and they get bought up by the spot buyers. Because what did I say? Really smart, experienced investors buy fear. They buy capitulations. People like me, we buy capitulations. And that is why bottoms form generally during liquidations. The pool, the total size of the hodl pool is increasing, because when you think about it, right, if you want a coin to go up in price, you have to have people buying here, 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 and here, and here. The less coins that can be bought from here to here, right, from top to bottom, the easier it will be for price to rise. Right? Let's imagine two scenarios. There's $1 million of coins, or there's $5 million of